Hi, Gary. It's so nice to see you. How are you?
I'm good. Thank you very much for having me.
Well, as you know, I'm a big fan. I've been following your writing, and I mentioned to you that I've been getting to know you through your writing. So it's what a pleasure to sit down with you and chat about some of the things you write about. And they rhyme with the way I look at the world, and they really resonated with me as well. So I'm going to jump right in. As you
hmm
may know, I like to ask my guests about their childhood and upbringing, and I know you have a story. I think there might be some parallels between our stories, but I'm curious how you think that time shaped your relationship with money and then led you to the career path that you're on today.
Yeah, no, again, appreciate you having me on, and sure, would be happy to share. I mean, I grew up in the former Soviet Union, Leningrad specifically, and St. Petersburg now. My mother thankfully took me out of there, which she reminds me of frequently, and she's right. She was just visiting the other day, and I would not be in good shape if I were still back there. And I was about 10 when we left, and this is before the fall in 1989. And we immigrated not directly to the United States, but we had to wait for refugee status. So we were living in Italy for 5 months, and
Hmm.
so I was, the way the immigration process worked. It's funny because first of all, you had to pay the Soviet Union government for the right to give up your citizenship. Just kind of
Hmm.
ridiculous, right? But you had to pay them. Next, that they were really worried that you're going to take like some massive amounts of money out of the country or something like that. So I think you were restricted to, I believe it was $125. Now again, obviously the dollar, a dollar today is not the same as it was whatever 30 some odd years ago, but still $125 even back then wasn't a lot of money per person.
Hmm.
It was three of us: my mother, my grandmother, and I. And essentially, what a lot of people did is they took whatever money they had that they couldn't take out, they bought a whole bunch of stuff, and you were allowed like one of everything: one watch, one ring, one, you know, binocular, one camera, whatever. Because the idea is that if it's one per person, it might be for personal use, but if you're buying 100 watches, it's obviously just trying to convert currency. Yeah. So and then immigrants like us, who were, so we lived in a little town for about 40, 45 minutes outside of Rome called Ladispoli. And there were two towns. Ladispoli was one, Santa Marinara was another. We lived in Ladispoli. There was a bazaar. All the immigrants were there and they were selling their stuff, right?
Hmm.
And, they were selling their stuff to raise money to eat because, there were some aid organizations that were giving us some basic stuff. But if you wanted something a little bit beyond the basics, you had to sell, your things. And so my mom would sell the major items, and I would be focused on selling little matches, and unfortunately, coming into this experience, like, so I had this ring my mom gave me, and it was her childhood ring. It was a tiny little gold ring, and essentially, I wasn't allowed to bring it out because we had more valuable rings, and so my mom said, "You have to leave it behind. We have to take something more valuable for that one ring that you allowed to bring with you." So I gave up
Hmm.
that ring, and on the way to the bazaar, I kept passing by a jewelry store, and that jewelry store had a little gold ring just like mine. And I would be selling these little matches. Signori, una mil, por favor. This is before the euro, so un mil was like, 1,000 lira was just like 70 cents or something like that. So I was selling these little matches, and then I made enough money finally that I could buy, this ring. And I said, "Mom, can I spend 5 mil, just like $4, to buy this gold ring, kind of to restore what I had?" Because like to a 10 year old, I was proud of myself, like I earned it, and I wanted to restore what was mine. And I went in, and I saw there was like, they looked suspiciously at this like Russian kid off the street, and but I had like 5 mil note clutched in my hand, so they kind of said, okay, he has some money. He's not like begging or anything, or trying to steal anything, right? Um, and I pointed to the ring. I couldn't really speak very much, and I saw as I was, picking it out, that there were like other, gold rings that were like 5, 10x the price. I'm like, oh, it's a great bargain, terrific, look at me. And the punchline is, I got the ring. 2 weeks later, I found out why it was so cheap. It was, the gold wore off and it was a silver ring. Now, I'm sure the store wasn't trying to defraud me. They probably just, listed it as such, but I just probably couldn't read enough Italian to understand that it was a gold-plated silver ring. And anyway, that's kind of the punchline is, A, not everything that looks cheap is a bargain, and B,
Yeah.
you got to do your research. You can't just like look at something, jump to the immediate conclusion and, have that work out as an amazing insight. And that's kind of where Silver Ring Value Partners comes from, as a reminder of those days.
But it's a remarkable lesson in price and value, and
Yeah.
reminds me of going with my grandma grocery shopping and how she had that instinct for looking for value and paying
Hmm.
the lower price. And the lessons of value investing, when you really think about it, we all acquire them one way or the other, and sometimes they resonate with some people and less so with the others. And
Hmm.
when we see the stock market and the tickers, a lot of that knowledge that we should have already somehow gets lost. The big point that you mentioned, I grew up in Poland. I remember the last decade
Hmm.
of the experiment, and then Poland became free, and it was a huge transformation. The country opened up, and I studied around Europe and moved to the US as an adult. So I got to see a massive change, and I think it shaped me in a certain way. I saw
Mm,
hyperinflation and
for sure.
many different things that my colleagues only know from books. I actually lived through it and saw it, and I think it became part of my DNA. And
Hmm.
you said something that was really powerful just now, that you tried to restore what was lost. Can you talk about that a little bit? I feel like I've met quite a few investors that had this experience of a loss early on. And then here it's a very emotional item that meant something to you. And you tried to get it back as soon as you could in a way that you could was, matching what you had before.
Yeah, until you asked, I didn't actually even think about it this way. In term, to me, it was almost like, okay, boom, I see it. It's close to the same. I want it because I had it. Now I don't have it, but I still want it, right? And but I guess your point is a deeper one too, because right, my grandma used to tell me, and I don't know how to translate exactly from Russian, but she used to say that you get in trouble not for playing, but for trying to get back what you lost, right? She probably
Mm,
was referring to gambling or card games or something like that, right? That you lose your objectivity and perhaps you make, emotionally based judgments, right? So I think there is that aspect, and in investing, it's hard because generalizing this to kind of all investing, like in an ideal world, you have independent decisions, right?
mm-hmm,
That you don't have any history with a stock, you don't have any history with you're not aware of your performance even, right? Like you should not act any differently based on whether your performance is good or bad or indifferent, because that's irrelevant to your optimal decision. Like, if you play poker, right, you will know that there are various forms of tilt or deviation from optimal play, and
mm-hmm,
there's losers tilt, but there's also winners tilt, right?
mm-hmm,
You're trying, like when losers tilt, you might be trying to get back into it, and you're more aggressive, and maybe you're swinging for the fences, and maybe winner, or maybe not. Different people have different. But sometimes winners tilt, people are just kind of loosen up, and they don't mind losing a bit of money here and there because hey, it's the house's money. They won, they would still be a winner. So,
mm-hmm.
and I think in this, I've been thinking about this the last few years, and I'm sure you read this, or if not, I'm sure you've heard of it. Like, there's a great little book called The Money Game by
Mm-hmm.
quote unquote Adam Smith, written
Yeah.
in the 1960s about the go-go years. And there's a great quote there that investing is about identity, anxiety, and money in that order, or something to
Mm-hmm.
that effect. And I think when you think about why that's the case, like it's really not about the money. I mean, now for me, when I was like a young kid and we were trying to make ends meet, it was about the money. But for
Right.
most serious investors, they have enough where the money is not the main thing. At
Mm-hmm.
least, certainly not in the short intermediate term. Maybe it is from a point of view of when can they retire. But I would argue even for a lot of wealthy people, it's just a matter of how much money they leave to their, their inheritance or whatnot. So it's not about like, if you think about the Maslow hierarchy of needs, we're not like at the bottom of the triangle. We're
Mm-hmm.
kind of like near the top, and it's like identity. And I think part of it is the mistake I think a lot of people make is, and I know we're a little bit on a tangent, so bring me back whenever you want, but it's
No,
like
go
having
ahead.
an outcomes based identity.
Uh-huh.
Like, and weirdly enough, like I am a winning player
Mm-hmm.
is a bad identity. And
Mm-hmm.
that seems weird because, like, hey, what do you want to be a loser? No, you don't want to be a loser. But, or having, I am an investor who beats the market by at least X, right,
Uh-huh.
over time. That's a bad identity
Mm-hmm.
because you are taking something that ultimately you control indirectly and selling it as your identity. And so the anxiety comes, right, when you
Right.
have evidence that's counter to your identity. I'm an investor that beats the market. You have a period you don't beat the market. Why is that so painful? Is that it challenges you as an identity. So, like, what's the alternative? Is an input-based identity.
Hmm.
I'm an investor who does X in a certain way, right? It says nothing about the outcome. Obviously, the outcome is desired and it's implied and it's kind of a targeted goal from
Hmm.
of the process. But measuring yourself against things that are within your control, because then here's the trick: is anxiety should come from, oh, I'm an investor who follows the following steps, and
Hmm.
I have not followed this step. That should bother me. That should challenge my identity. And now this is a good feedback loop because now it brings you back to what you in your calmer state and at your like very best and rational set out as your kind of process. Versus if your identity is, hey, I'm someone who crushes the market,
Hmm.
and if you have a period where you have a tough period of performance, you A might get depressed, and certainly
Hmm.
that's not good for you or for anyone else. Or B, you might start doing crazy things just to catch up, get back to your to having your identity be true. To your point of getting back to even and things like that.
You touched on so many interesting things that I write about and I discuss. So focus on the process, the things that you can actually control, what kind of businesses you're willing to buy and why and how and so on. And the industry is spending so much time on the result. Like, show me your performance, and you can slice it and dice it. And these days, with the data and the computers, you can ask for a daily performance, and it can ask you, did you perform or outperform today, which is completely irrelevant to the big picture. So I think the fact that we can measure so many things and compare so many things makes it harder to stay focused on what actually matters. What kind of businesses did you buy and why gets kind of lost. And I see so many people join the profession or join the investment world just seeing the rewards, how many times they can grow the money and how quickly, and the different benchmarks and how quickly they can compound. And the process, it's where the secret is and where the success is really hiding. That's what I'm hearing.
Well, I would add that it's not the process, right? Because think about it this way: how many people you know who can quote Warren Buffett or Ben Graham or Phil Fisher or
Hmm.
whatever, or Nick Sleep letters or whatever is in vogue, in the current, kind of meta state of investing. Like, there's a lot of people who can quote this very well and write down the process in theory or articulate the process. It's how well you execute the process. Like,
The
how
practice.
many people running around calling themselves cloners of Warren Buffett, and how many of them have cloned Warren Buffett or even come close, right?
Hmm.
None, right? Why, right? We go to Berkshire Hathaway. I haven't gone a bit, but I've gone 10 times in my 22-year career, and I'm always amazed by the tens of thousands of people, and
Hmm.
then how few of them actually invest the way he says right? So it's easy to state something. It's much harder to do it under pressure, is what I'm saying.
Of course. You point out something really interesting. When you are really honest about it, the principles are well described and written
Mhm.
down and coded, right? We're way beyond where Ben Graham was starting off 100 some years ago. So we all know it. It's been documented. I mean, Buffett is a great example with annual letters and so much information and so many people researching him. But actually practicing what you think you preach, it's the hardest thing. And it's hard both in bull markets and bear markets. And I'm sure we'll talk more about it. But you're right that the principles, the process, we can all write it down. It's pretty straightforward. It will mean different things to different people. Even when I say, oh, this is a cheap stock, we might disagree what it means to you and what it means to me. But then the big principles that we talked about, shopping for the ring or shopping for groceries with my grandma, the same idea, but actually sticking to the practice. Gary, I want to ask you about your very first investment. And I really like that question. I mentioned to you that I like to ask that question when
Yeah.
I'm giving talks about investing. You have a story, and you lost quite a bit of money in that first investment. Do you mind sharing?
I have two stories. You probably are thinking of one of them, but I'll give you the short version of both stories. So, like, my very first stock. So
Hmm.
I was studying MIT. It was the middle of the tech bubble. I think the late '99 or very early 2000, and I finally had some savings. I still had a negative net worth with the college loans and all, but and I was working two jobs to pay, the loans. But whatever. I like had a couple of grand. I went to Fidelity or I think it was E-Trade brokerage at the time, E-Trade brokerage, and read some broker report. And there was this tech company that Cisco was rumored to be, thinking of acquiring. 'Cause Cisco at the time was a big acquirer of like networks related businesses. And based on just that, I just put all my savings into that stock, right? And I can't tell you how many times I've looked up that stock price or where, and I'm going to stop right at that. I would check the stock quote on that. And then I was fortunate that Warren Buffett came and spoke at Sloan School of Management, the business school at MIT.
Hmm.
And he wasn't very popular back then. Certainly he was well known, but not as popular as he was before the bubble or he is now, because his performance was bad. People thought he had lost touch. There was the new economy, all of that stuff, right?
Hmm.
And he talked about some very common sense things that were just immediately obvious as soon as he said them, like long term intrinsic value of a business versus the stock price at the point in time in the market, competitive advantage, things that just immediately made sense and made me realize I hadn't been investing. Like I thought I was just speculating on
Hmm.
rumors, and I was kind of ashamed of myself, and not enough to sell that stock. I sold it at a loss a couple of years later, but that may because it was down. It was probably because I was trying to get back to my cost basis, right? We're all human, right? Now, again, I was 20 years old or whatnot, so I'm going to forgive myself there. So that was kind of my kind of origin story. And then when I joined Fidelity Investments as a young equity research associate, um, you know, Fidelity worked in a strange way because you come in out of undergrad, you have no stock picking experience or research experience, and you're given a small industry, and you're
Hmm.
told this is your coverage. You're not bringing coffee, you're not building spreadsheets. You literally are the analyst representing
Hmm.
Fidelity. You would be interviewing CEOs and as the face of Fidelity, and you get 3 to 6 months. At least that was the deal back then. And then you come and you do an industry review of the industry and which stocks you buy and which ones you avoid, right? And to a young kid, like it's like wow, there's like a billion, $500 million of ownership of my stocks. Now
Hmm.
Fidelity has 500 trillion of active assets, so from their point of view, it wasn't exactly a big risk because again, if sorry, not 500 trillion, 500 billion, I misspoke. So but 500 million of ownership is like not even a bad day in the market for them. So Gary's stocks could disappear, but to you or me in that case, like where you
It's
have a
everything.
negative 10,000 net worth with college loans, like 100 million here and there is real money, right? And so there was one particular stock, and the name was Poly One, very early in my kind of career there, where I fell for all the classic mistakes, where it was very cheap. It had a very well dressed, CEO who came from Harvard Business School, who had this, strategy of cross selling, different plastics based stuff to the same customers. So he was acquiring different things. Um, and I'm like, okay, it's a 10 times earnings. I think it should be worth 15. It's two-thirds of intrinsic value. 65 cents on the dollar. I was all gung ho about value investing. And I remember recommending it. We bought more. We owned like close to 15%, which is the maximum we could own, of that company. And then one day, I remember that like it was today. It was like a day before Christmas Eve, like 23rd, I think, of December. First of all, the stock was sliding going into that. And the portfolio managers were saying, "Hey, what's going on?" I'm like, "Hey, no, we should focus on the business and the fundamentals and the value. Use the market." I was like all into quoting Buffett, like I hear many people do today. And the stock kept sliding. So finally, one of the senior portfolio managers said, "Listen, we need to do a call with these guys."
Hmm.
I'm like, "Fine, you're the boss." So we do the call. We talk a little bit about baseball for 5 minutes, and then basically the portfolio manager very surgically extracts exactly how the quarter is going. Like with and so many it's very clear that they're going to miss numbers. But I'm like, all right, I know they're going to miss numbers, but we should stick through it. Now it's at 60 cents in a dollar or whatever, right? And then when they pre-announce the results the day before Christmas Eve, not only that, but they eliminate their dividend and have a
Hmm.
massive pre-announcement, and the stock literally goes down by 50% on that day.
Oh
But
goodness.
I felt like throwing up. And I remember, at Fidelity, you had to make the rounds, especially when like something bad was happening to your companies, you had to go to all the owners, the portfolio managers, give them an update. And I did that. And one of the last guys I spoke to, who wasn't, I think he thought he was being nice, but he was kind of a jerk. But he probably needed that at the time. He's like, "What are you doing? You need to go home, take the rest of the day off, and reread your Warren Buffett because you're not understanding what." So I'm like, and I was like, okay, I'm like, all right, I'm gonna go now, So I literally, like, as soon as I finished what I needed to do, I went, and like I really had this period where I was like, how could this have happened, right? I thought I followed it, and just, right? And then you understand the nuances, the many layers of understanding, and how it all builds. And also, you understand how humbling of an endeavor active investing is. And it's, I've done this for 22 plus years now. It's harder. I think it's harder, not easier. Not because I think it's necessarily gotten harder, but because I just, as you do this over time and you get humbled, and then you have successes, and you get humbled, you get successes, you
Hmm.
appreciate the difficulty of what you're trying to do more than when you're starting out and you're like, yeah, I'm going to apply intrinsic value. I'm going to go and buy stocks at 50, 60 cents. It sounds good,
Right.
but like doing it is very different. So I think that loss, and again, losing 50 million, on paper was very painful. I kept
Hmm.
my job. I wasn't sure if I was going to lose it or not, but you know, I think as I came out the other side and started having some additional successes, and I kind of built on that classical value investing foundation and
Hmm.
combined it with different behavioral mental models to create something that, for me, I believe is stronger and better. Because I think just value investing alone is fine, and I think
Hmm.
there's still room for that. Like if someone wants to be a pure classical value investing practitioner, if
Hmm.
they're really good, they can still eke out some excess return, but I think it's a lot smaller than it used to be. But I
Hmm.
think that having that extra layer, for me, that's the behavioral models, I think is super important.
I really like what I'm hearing. You mentioned Fidelity. I learned what Fidelity is while reading One Up on Wall Street by Peter Lynch. I was an
Mhm.
exchange student from Poland in Brussels in a little English language bookstore, and I was studying business economics, political science. I wasn't really sure
Mhm.
where I'm going with this. And it was short after the internet bubble burst. My professors were not fans of the stock market, and I think they lost money in the stock market, and they were
Yeah.
hating on all the companies, including Amazon among them.
Yeah.
And this book really spoke to me because nobody explained to me that stocks are small pieces of businesses. And as obvious as it sounds to me now, back then at 20 something, it just spoke to me. So it
Mhm.
meant that I can collect businesses. No matter if I have hundreds of dollars or billions of dollars, I can become an owner of multiple businesses. And if I do my work and I find quality ones and I hold them for the long run, some of them must work out, as Peter Lynch writes in his book. And you might already know a lot about a lot of businesses, more than you think. And it was such an inspiring book. And then I started looking for everything else, and I found Buffett and Graham, and I read a lot of books that didn't help me as well, but quite a lot that really guided me in the process. And I like this lesson that it's a very humbling pursuit that you mentioned.
Yeah, and I was fortunate to meet Peter a couple of times. He was already retired, and he was more mentoring
Hmm.
folks. And he had a lunch with a few of us associates, like a 4 or 5 person group lunch. And I remember preparing for it. I read both Beating the Street and One Up on Wall Street, thinking, okay,
Uh-huh.
I'm going to come into this lunch really prepared, like to get the real scoop or the next level. Not the real scoop, because I don't think he was being disingenuous in his books, but the books, at least on first reading, could be a little misleading.
Hmm.
Not because Peter was trying to mislead, but because like the usually the takeaway that people get from it is like, oh, you go to the mall, see where the line is, and then you invest in that, or invest in what you know.
Hmm.
My wife buys leggings. I like, okay. How do you like it, honey? Good. Okay, right. So it's like
There's more to it.
oversimplification.
Hmm.
And I was hoping, I'm like, hey, Peter, can you tell us, like, how do you actually do it? And he started launching on the same stories. I'm like, I read the books. Tell me the real thing. Um, and the real thing, obviously, is that might be a good place to start. It might be, what he was trying to say, I think, is that the retail investor has an edge over the professional, and that they might have some area of their lives where they already know things better, and that's where they
Hmm.
should stick to. but I think it
Hmm.
gets misinterpreted as like, hey, see where the lines are in the mall and invest there, which is not, I think, what he's.
No, it's much more nuanced. To me, the idea that I get to be an owner of businesses, that's what really spoke to me. And which businesses and how I will research them, that followed with, obviously it's been almost 2 decades of experience. But in that moment, in the mind of a young student, the idea that I get to own those businesses, it just really blew me away. And none of my professors told me that. So I really
Right.
appreciated that book. Gary, I want to ask you about your articles, your Substack, Behavioral Value
Hmm.
Investor. There's a piece where you write about the attention, our attention. You say that our attention is a finite resource.
Hmm.
I practice what I call selective ignorance. So there are big parts of the world and the market that I completely ignore. And it wasn't the case when I started off. When I started off, I thought I have to know everything. I would go to every single meeting at the firm where I was at, all the way from mining stocks to growth stocks to anything that was coming through the office. And over time, I just developed a certain filter. And the filter gets tighter and tighter, I think, as I'm spending more time in this business. Tell me more about that attention, why it matters. And you tell us in your article how people might be stealing our attention. Tell me more about that.
Yeah, well, I mean, this is kind of really fresh in my mind because I just came back from give a talk on behavioral defense and investing at a conference where there was a gentleman, Apollo Robbins. Highly recommend you look him up. He has
Mm-hmm.
some great videos on YouTube or his website, and he literally calls himself the gentleman thief, and he can
Mm-hmm.
steal anything from you. After telling you, he'll tell you, "I'm gonna steal your watch in the next 15 minutes," and you're like, "Now you told me you're gonna steal my watch." Right? Um, and he was also a speaker there, and so we kind of also talked offline quite a bit. And the little changes in how he moves or how he acts that guide your attention to something,
Mm-hmm.
which then takes it away from something. So the way he talked, the paradigm he said is like, imagine there's a security guard in your mind. And he called him Frank in his like
Mm-hmm.
little talk, and he said, okay, Frank sitting at his security, watching the cameras. He's looking through the eyes, listening through the ears, and he has a filing system. And if something like piques his curiosity, like, or he might turn around his filing cabinet and start going through the files, looking things out, which means he's not looking at the cameras anymore. He's not listening, right?
Mm-hmm.
So it's not so much about misdirection; it's about how different inputs take us in one direction. But because our attention is constrained, we have one Frank. We can't clone Frank in our minds to 10 Franks. That Frank is now looking to the right, but the
Mm-hmm.
action is to the left. And I think there's two type of things, right? There's environmental factors. So I remember at Fidelity there was an old PM who had his Bloomberg terminal set up behind him, right?
Mm-hmm.
And I've met investors in the past who purposely put their Bloomberg terminal outside their office completely, or don't have a
Mm-hmm.
Bloomberg terminal, or whatever, right? Right? I think Guy Spear talks about having it in the library or something like that, right? And so you have this, you creating an environment conducive to what you want to do. Like, for example, I can be easily distracted. I know that, just my personality. So sometimes I'll plug my phone in a different room to charge,
Mm-hmm.
and and that prevents me from like every 10 minutes checking something on my phone, right? So I'm not even giving myself that option. But there are other like environmental factors, right? It's, you know, there's the old kind of, I think I'm not sure it's true, but probably maybe it's true, like that the best investors are not on either of the coasts. They're kind of in the middle of the country because they're not
That's true.
distracted by
Mm-hmm.
the same flow of information and flow of noise, really, where there's like group think on the coasts, and then there's this quiet thinking areas in the middle of the country where there are fewer companies coming through, and there's just more time to read and think and reflect. Again, not sure if it's true. Heck, I'm on the
Mm-hmm.
coast, but I'm on the coast because I like living in the Boston area. So I'm not gonna, I have 3 kids and a wife. I'm not gonna try to optimize for living in like
Omaha.
in Omaha. Although if I'd grown up in Omaha, that'd be perfectly fine. I just, I haven't. But I think like, there's environmental stuff, and then how
Mm-hmm.
do we carefully curate our environment, right,
Mm-hmm.
and be intentional about that? That's like a serious thing to think about. Like, and it's even like, who do we talk to? Like, if you keep talking to people who are like, "Hey, bro, how'd you do today? I was up 50 bips," right? That's such a toxic like
Mm-hmm.
input, because you might think, I like this guy, overall he's good. Yeah, she's a little short term, but hey, he's just, I don't have to engage with that. But just that very question
Mm-hmm.
already engages. You can't prevent yourself from engaging at some level with that question,
Mm-hmm.
right? Um, and same with clients, right? I know it might sound arrogant to choose clients, but I don't think you have to be choosing them in the sense of a high and mighty. It can be like it's a mutual selection, like you're dating in the business sense. You're like, hey,
Mm-hmm.
by being very honest and very direct of what you're about, what you're not about, I think you can kind of repulse the wrong kind of clients and hopefully attract the people who are more like-minded, right? Because again, like having people who are like dripping poison about monthly performance to you, good or bad, like having,
Mm-hmm.
hey, awesome month. Like, well, first of all, if you tell me awesome month,
A
you
bad
are
one is coming.
confusing randomness with signal, right? Number one. Number two is you probably are going to be equally upset about a bad month, which is equally as likely, more or less, right? In the short, right?
Mm-hmm.
So there's a whole bunch of things. And now you think, you just said month, so my mind, my brain goes into month. I want, we want years, right? So there's environmental, and then there is like defense against people trying to literally use various behavioral techniques on you, whether it's management, right? Whether it's various salespeople,
Mm-hmm.
or people who are pretending not to be salespeople, but they really are, right? I always enjoyed, like, there would be these insurance salespeople who would come around from a big firm. I don't want to name a specific firm because I don't want to malign anyone, but they would always have some tax saving scheme, like, that would be like some
Mm-hmm.
kind of vehicle where you can only do better than the market. You can never do worse. Your money is safe. Everything is great. And
Mm-hmm.
and here's the thing, right? Like, that they've spent months or years perfecting the pitch.
Yes.
You also know that there's no free lunch. There's no, like, they can't, like, like,
No.
right? So it cannot be better in all respects. There must be some flaw or some set of circumstances where maybe you have a lot of good outcomes most of the time, but infrequent catastrophic outcomes, or something such that this is not a free lunch. But it would just take too long to figure out, because they have you at a huge disadvantage. They already figured out, and they hid the bad outcome somewhere in the payoff profile, right?
Uh-huh.
And so just meeting with those people. Now, I did this for fun because I had no plans to. I mean, I invest in my own partnership, but like, I mean, for most people that would be a mistake, because these are
Mm-hmm.
people who are very persuasive. They've
Mm-hmm.
designed something to appeal to your reptilian brain. There was a
Mm-hmm.
book once I read about this, and he put it the following way. He said,
Mm-hmm.
your reptilian brain, your primal brain, when they see something, they it asks the following questions: is it dangerous?
Yeah.
Can I eat it? Is it interesting?
Mm-hmm.
Can I mate with it? Those are the
Mm-hmm.
four questions. And if you think about those four questions, that's pretty much it. Like, you see a person, an animal, an object, those are the four choices. Dangerous, interesting, you know, eat it, mate with it, right?
Mm-hmm.
Those are like, that's the reptilian brain. It's functioning at a very basic heuristic
Mm-hmm.
level, right?
Yeah.
Um, and so I think that you have people who are very good at sending and manipulating their reptilian brain
Mm-hmm.
in a way that your higher order kind of like cortex brain is not able to necessarily override, and not even aware,
Mm-hmm.
right? And the punchline from this gentleman thief, and then I'll yield the floor back to you, is that he one part of his kind of performance, he would say the easiest way to steal a man's wallet is to tell him you're about to steal his watch. you know
That's
right?
a good point.
Because he would literally be like, holding the guy's watch, all the attention would be on the watch, and with the other hand he would be showing the audience behind the guy's back that he is already dangling his wallet, right? Because he just focused, right? So I think just some of the answers probably just say no. When a
Mm-hmm.
persuasive salesman says, "Can I have a meeting?" The answer is no.
Yeah.
I don't know your game, but it's like the Nigerian prince, right? Once
Mm-hmm.
you reply, you've
Mm-hmm.
selected yourself into the next part of the funnel, right?
You're in.
Because it's designed in a way that smart people from the Nigerian prince email, right, are supposed to
Mm-hmm.
see the typos and the misspelling, so they come out of the funnel, and the people who are not that bright reply, and then they engage with the people who said, "Hey, I'm gullible, defraud me," right? So again, I'm not trying to knock all salespeople, I'm sure there's salespeople selling really valuable things. But I
Hmm.
think in the investing business, more often than not, if someone is really working hard to sell you something,
Hmm.
chances are it's better for them than it is for you. But that's just my experience.
No, that's a good way of looking at it. And sometimes I think about the practice that I have, managing money for families, long-term patient capital, and it's not something that can get sold. It's not an easy sell. It's more about building a relationship, earning
Hmm.
people's trust. But when people say, what's your elevator pitch? I don't really have an elevator pitch. I can tell you about what I do, how I do it, and either it resonates or it doesn't. And usually over many, many conversations, something can come out of it, a potential new
Hmm.
client. But it's not, there's no catch, there's no pitch, there's no, there's a story, there are
Right.
examples, but it's something that you earn over time. And then once clients come, they tend to stay for good, which plays well into the philosophy itself. In that piece, you tell a story of a money manager that had 3 bad years at some point in the 70s. He even lost 50% of the client's money,
Right.
but he still got ahead of the market. And it's a manager that was featured in an article that Buffett wrote about a few followers of Ben Graham. Who was that? What happened? And what we
Yeah.
should have paid attention to in that story.
Well, I think it's kind of so the article first of all is the super investors of Graham and Doddsville. It was
Mm-hmm.
written in '84, and the bigger point that Buffett was mentioning, this is like based on a talk he gave at Columbia to
Mm-hmm.
explain to folks that look, value investing works, and it works even when implemented by very different practitioners. And so he's
Mm-hmm.
saying, well, maybe people got lucky, right? But here's a whole bunch of records with fairly long numbers. And then he said, well, maybe, because people say it's like monkeys in a zoo flipping coins or throwing darts, lucky monkeys are going to have good long term track records flipping fair coins, right? He said, well, what if I told you, right, that all the monkeys came from the same zoo of value investing, right? And then he said, well, what about another theory? What if all these monkeys were copying a lead monkey, meaning their portfolios they were kind of bunch of cloners,
Mm-hmm.
and one leader? He said, well, no, look at their portfolios. Their portfolios are very different, even though they're achieving very good results. And there was one guy there who had 3 years in the 70s that were just god awful. This
Mm-hmm.
was like, not just on the 3 year basis that he underperformed. He underperformed every year over that 3 year period, on a 3 year basis as well.
Mm-hmm.
And he did this in a down market.
Mm-hmm.
And he was down 50% or so in a market that was down low 20%.
Mm-hmm.
And and there are clients out there. So like, just before kind of I mentioned who it is, like there are clients out there who kind of think, well, listen, I'm being objective, man. You don't
Mm-hmm.
want me to, I'm not playing favorites. I treat you the same way I treat everyone else. Look, I'm looking at your 3 year numbers and I'm looking at everyone else's 3 year numbers.
Mm-hmm.
And they don't understand how terrible that is as a selection tool because, first of all, back at school, when I took an investments class at Sloan with Ken French, he
Mm-hmm.
derived in the board how long does it take to get a 90% confidence that a record is skill and not luck in the mutual fund business or in the fund business in general. And it's 12 years based on like the average return, average volatility, and so forth, right?
Mm-hmm.
The likelihood of 3 years being skill versus luck is something close to 50-50, right? The punchline is this one guy was Charlie Munger, who, over the whole record, is beat the market by 5x and compounded capital, 13% net of fees, while the market did 5.
Mm-hmm.
So, but and there is this bias, like, right, that we now know who Charlie Munger is. So if we were to say that Charlie Munger had a bad 3 year period, we would,
Mm-hmm.
of course, our biases would, in this case, positive biases would rationalize it, right? So, well, of course, yeah, but imagine you didn't know, but like if you are a client or potential client who is using that as your only or primary tool,
Right.
you are doing exactly what the salespeople in this business want, which is you buying high
Mm-hmm.
and then selling low and then
Mm-hmm.
rinsing and repeating because usually 3 years means nothing
Mm-hmm.
And when you're redeeming someone's fund after a bad 3 year period, and then buying into someone's fund who had a really good 3 year period, you're probably getting into exactly the wrong time and getting out exactly the wrong time. Not always, but at best there is negative correlation. So I think the punchline is you're going to have good records that have bad periods, even to mere mortal normal human people,
Mm-hmm.
seemingly super long periods like 3 years, which is a long period of time. Imagine coming into work for 3, 4, 5 years and knowing that what you could have done could easily be replaced by the market. It sucks, right?
Mm-hmm.
It sucks, or surpassed by the market.
Mm-hmm.
Nobody in their right mind wants to do it. But
No.
then again, if you start thinking in that terms, again, back to having an identity that's outcome based as opposed to inputs based,
Mm-hmm.
you're going to make worse decisions. So you have to separate yourself from outcomes and focus and judge yourself truly, like inside your like privacy of your mind.
Mm-hmm.
You have to judge yourself based on inputs. Like, are you proud of what have you been doing? Not of
Mm-hmm.
what the outcome, but what you have been doing. And there was a book I was reading. I think it was called The Creative Act.
Oh, it's a
And
beautiful book. I
yeah,
love
there
it.
was a beautiful quote in that book. Something like, "Success is measured in the privacy of your own soul," or something
Oh,
like that.
I like
You
that.
know,
Mm-hmm.
and I think of that quote because it's so true, right?
Mm-hmm.
Like nobody, like the real success, not how much money you've made or what are you the chairman of some local board,
Mm-hmm.
or social, whatever, but like if you're successful or not.
Mm-hmm.
You know?
It's a
Nobody else,
beautiful.
and nobody else can make you successful if you know you're not, right?
Mm-hmm. It's a Rick Rubin's book that you're talking about.
Yep.
Yeah,
Hmm.
Chris Mayer told me about it, and I read it since. It's just a remarkable book that I highly recommend, and it made me think about work and input. You call it input, process. How do you actually operate? How do you work? And
Hmm.
how do you evaluate? How do you think about it? And it's just it made me reframe how I look at certain aspects of the work that I do. I wanted to come back to Charlie Munger and that period, the 70s, for a couple of reasons. So today, a lot of people are really in love with passive investing, and I think it can work in certain ways in certain circumstances. But between 1969 and 1981, the market went nowhere. It was a very tough
Hmm.
period for a lot of
Yep.
investors, and I know a lot of families that had to invest through that period and were very confused about how to navigate that period. And there were some early attempts in index investing at the time. By the way, index investing had many names, but it was also practiced in the 1920s, towards the end of the 1920s. And there was a different name for it, but basically you could buy a basket of fastest rising
Hmm.
stocks and participate in the success of a bull market until it stopped working. So I think of it in many different ways, but a lifetime of contributions and distributions. The clients that I work with usually experience distributions going forward. They'll be using the capital. So all of the
Hmm.
capital has to be somehow invested up front. And while somebody that lives a life of contributions and puts away 100 or 1,000 over a period of time, I think passive investing allows you to both participate in the market and spread out at what prices you're going to participate in. So it's more nuanced than how you think about it. But I just wanted to throw it out there. 1969, 1981, not an easy time for
Yeah.
investors, not an easy time for passive investing. I want to
Let me
ask you
let me
about.
challenge you. Oh, sorry. No, go ask a
No,
question. Ask a question.
I was going to switch gears and move to the other practice that you have, which is bonsai. You've been
Well,
practicing it
well, so since you're
but
moving up,
before
I'm
we
going
go
to
there,
challenge
yeah,
this a little bit on the passive, and then I'll be happy to talk about bonsai.
tell me.
Here's the problem, right?
Mm-hmm.
Like, so I've been in the business for 22 years.
Mm-hmm.
I would have a hard time right now telling a friend of which 5 active, mutual funds he or
Mm-hmm.
she should buy and hold for the next 20 years that I think will beat the
Mm-hmm.
market net of fees and frictional expenses and taxes by 1% or more.
Mm-hmm.
And and here's the problem. I think you're right. There are plenty of issues with that, passive investing. One of them, being that if you have a lump sum, it doesn't work nearly as well as if you have constant inflows and you're automatically diversifying, like you were saying. I mean, there are other issues with it as
Mm-hmm.
well, right? If you have long periods where the market is flat, like the one you mentioned. But I think the problem is that like, so I go back to when I was quote unquote growing up. In some ways, I'm still growing up, but like I had my value investing idols. You know,
Hmm.
I'm not going to name them by name because I don't want to speak, and I'm not speaking poorly of them, but I kind of, I don't want to cast a shade on anyone. But I think there were people you would know who were running multi-billion-dollar value firms who
Hmm.
were looked up to by a generation of aspiring young value investors. And then I look back, I did this exercise the other day. Like not one, two, most of them have been completely, crushed by the market over 20 years plus.
Hmm.
And now that maybe there's an endpoint bias. I get that that could be a thing, like
Hmm.
we're ending in the point that's unfavorable for them. But there were a
Hmm.
couple of cycles in that period, so it's not a complete, it's not a 3 year period, it's like a
Hmm.
22-year period. And the market during the 22-year period that I've been practicing is growing at about 10% nominal, which is about average. It's
Hmm.
not, it would be, and some of these investors who again on paper had this amazing process, price to value, intrinsic value, all the right things, all
Hmm.
the resources in the world, billions of dollars, full scale, all that, and they had like instead of 10% per year, they had 5 or 7 or something like that.
Hmm.
And I honestly, when people ask me, I struggle to say why they should not do passive investing because I think to me like the main reason to deviate is if you can assess the process of the manager and the quality of the person implementing it. For
Hmm.
most people, that is like near impossible, right? For some person out there to figure out if this mutual fund manager is any good, it's just not going to happen. And I'm not
Hmm.
even going to get into the whole financial advisory kind of RA business because a lot of it is a confidence game where people substitute other services or appearances of services for results ultimately, right? It's like well-dressed person who treats someone really nice, that gets to know them, makes them feel comfortable, but the person would be better off in Vanguard, and they're paying an FTP for the privilege of being made to feel important by someone in a nice suit. So I think the challenge is, while in theory there could be times where passive investing totally isn't appropriate, in
Hmm.
practice it's really hard to do better for most people. That's my tirade. I don't have a passive product. I'm not selling anything. I just like observe that.
Hmm.
I'll even, you know what, I'm gonna do a personal reveal and then I'll stop and we'll talk about bonsai. About 10 years ago, I put together in my retirement account a
Hmm.
portfolio of 5 mutual funds. This is
Hmm.
after I already been in the business for 12 years. I knew a bunch of things. There was some small cap, it was large, international, so like a pretty balanced portfolio. I mean, that whole portfolio over 10 years got completely trounced by the S&P. And again, maybe I'm bad at picking funds, but like I worked inside several mutual fund complexes. I knew some of these people. I knew their processes. I don't know who could possibly have a ton more information about assessing the processes. So, and I don't know how many people have actually picked mutual funds for themselves in a way that they're much better off after everything. So anyway, I think it's aspirationally good, but in practice, for a lot of people, I think it's a hard ask to beat the market this way.
No,
Unfortunately, I wish it weren't the case.
no,
Yeah,
I think it's a great way to frame it. I think passive can work very well in certain circumstances, and I'm glad it's available. For the fact that, and we spoke about the ownership of businesses. Let's say I'd like to be an owner of many businesses, and passive index investing is such a low cost way to participate in the success of all those businesses, because that's what it really
yeah.
means to me. I know that people use it as a trading tool. I know that it's being used in many different ways. That's why
Right.
there's volume and liquidity in it. But that's a,
Hmm.
a whole other topic. But as an investor, as an owner of businesses, for me to have a way to participate in the 500, 2,000, whatever the index has, at the same
Right.
time at a low cost with $100 or $50 that I was able to save. I mean, it's remarkable. It really democratizes the access, right? And then many other things you touch on. I think it's a whole other conversation. The time frame that we're looking at, I feel like we're in a very peculiar time. We're talking here in
Yeah.
late October 2023. Uh, there are a lot of strange things happening and that have happened in the last 5, 10, maybe even 20 years, including the fact that a
Okay.
handful a handful of stocks is moving the index around. So if you don't have them, you're in trouble.
Correct. Yeah. No, totally. I mean, that's. I mean, honestly, I'm hoping you're right because as someone who's an active investor, my mind is screaming for a exoneration of the, right? Because like I totally would love for it to be some anomaly that's specific to this period and once, but I also want to be cautious that as the yeah. But let's talk about bonsai.
No, no, but one more thing that I'm going to add. You were talking about something at the beginning that I want to bring back when you said, and I used the word process and then practice. Let's just use the two words.
Hmm.
Process meaning I'll tell you what I'm going to do, and practice, you're going to see me actually
Hmm.
do it, right?
Yeah.
And I think with passive investing or with any automated way of going about it, there is the practice. Gary, I'm going to put away 500 and I'm going to put it in those three funds, and then you actually going to watch me do it. And the problem is that I've noticed with investors is that they can't stick to it, and I've seen people get out of the
Right.
market in moments that are they're zigzagging the wrong way, right? So they're
Yes.
getting out at the low, getting back in at the high. So the tools are there, the practice is there, the principles are there. And I noticed that a lot of us just need some help. And that help might
Hmm.
be saying, this is not the time to sell, this is not the time to buy. So
Right.
sometimes when I think about the highest value added that I have managing people's money, is that I
Mhm.
show up in those moments. They give me a call in March of 2020 and they tell me, I just wanted to hear your voice. You seem to be calm and collected, and you're probably buying. And I say, yes, I'm buying. They know what to expect. And I'm there as a buffer, as a source of courage and commitment to whatever it is that we were planning to do. And that's where I see that the value really happens. It's not that I'll outperform or I'll make some claims that are hard to deliver on, but it's just that kind of slow and steady approach.
Right.
And I had Daniel Crosby on the show, who talks about the behavioral investor mindset, and he has some interesting thoughts about how you evaluate managers. And there are moments where that person stepping in and saying, no, this is not the time to sell, adds a huge value to the client. So yeah, if you could really commit everything to an ETF and never touch it, and you have the stomach for it in March of 2020, and there will be other days like it in the future, or you have the stomach not to go into crypto and any high flying things in times of when your neighbor is getting richer than you,
Right.
then yeah, you can do it all on your own. But I think it's harder than we think.
True.
Let's talk about planting trees. And I really like that essay. And tell me what that practice of bonsai taught you about investing, Gary.
Yeah, I think it taught me a lot about myself, right? Revealed my own flaws like impatience and wishful thinking. But I would say at a very basic level, like one thing, it took me years to realize, it's like thick skull, like just didn't wasn't going through. Is like you can't change the species. It sounds obvious, right?
Hmm.
So first of all, just to make sure everyone understands, like bonsai, bon means container in Japanese, sai means tree or plant, bonsai, container plant, container tree. You're trying to recreate a illusion of or feeling of a giant tree in miniature,
Hmm.
right? Now, what that would entail is obviously you need to have certain proportions between trunk and branches, between branches and leaves, and so forth. Some species lend themselves to that much more readily. They have small leaves or leaves that reduce
Hmm.
because what you're doing in bonsai, you're giving the tree a very small amount of soil
Hmm.
and a very specific, you're a specific soil that's actually you're putting on a diet. Like you're stunting this tree growth so that it has to really work. The roots ramify into many many little fine roots and hopefully many many fine leaves. But there are
Hmm.
some species that just don't do well, no matter what you do, right? And like some example might be a species where the leaf still stays big even if it's on this extreme diet of a small container with tough soil, and then you'll never achieve the proportion. So you can spend years and years,
Hmm.
but you're not going to get the result you want. And it's kind of like going back to full circle to the beginning of our conversation about poly one and like some of these. lower quality stocks that,
Mm-hmm.
from time to time I still like get tempted by. It's like, you know, like almost every value investor now says, people, business,
Mm-hmm.
price, and maybe
Mm-hmm.
people, business, balance sheet, price. That's like everyone's slides, right?
Right.
But you can go full extreme and only go buy Amazon, Visa, and whatever, and then you probably rarely ever get a really distressed price. At least if the markets work the way they're supposed to, right?
Right.
And certainly not for a large basket. You can maybe have a differential insight for one or two or three of these, but it's very hard to have differential insight for like 30 of the world's best businesses all the time, right? Maybe not for everyone, but for most people. So
Mm-hmm.
then, I think you get this choice of like, my old mentor at Fidelity, Joel Tillinghast, had this cartoon in his deck where a guy walks into a store and
Mm-hmm.
asks the owner, "Hey, I'm looking for high quality and low price." And the owner
Mm-hmm.
says, "Sure, I have both. Sure, of course, I have both. Which one do you want?" Right? And so this tension, at least in the market of the last 2 decades, which I would say are relatively efficient outside of a couple of dislocations, like 0809 was the last major one of
Mm-hmm.
any length. Like COVID was probably too brief before the
Mm-hmm.
government stepped in to really
Right.
call a major dislocation. You had this choice, like if you want the price, if you want that 60 cents on the dollar,
Mm-hmm.
you are pushed into certain species of businesses or species of people. And I guess I don't want to get species of people. I'm not trying to
Mm-hmm.
say they're not subhuman or something like that. They're not Neanderthal. What I'm saying is, you're making a trade-off, and
Mm-hmm.
then you're trying to get compensation for that trade-off with the price. And it's kind of like reminds me of my early bonsai days, where I would go to this tree nursery and see this $30 piece of nursery stock. Like, yes, it's like a juniper, yay, And then, but what you don't realize is that the money you're going to spend on supplies, on the pot, the
Mm-hmm.
time, the space, the opportunity cost in terms of another tree that you could have had, because I have a small property. I don't have room for hundreds and hundreds of trees. So
Mm-hmm.
like the $30 is completely becomes irrelevant, right?
Right.
You would be far better off paying $100 in that case, or whatever, if it had the right characteristics, and for no price, even if it's free, even if someone
Mm-hmm.
pays you, should you spend your time with things like that are just not going to work? And
Uh-huh.
I think the equivalent of that investing is like just people like who are dishonest or self-serving,
Mm-hmm.
even if it's a little bit, like it's just not going to work. Like no
Mm-hmm.
amount of cheapness can. And the problem is people don't come out and say, "Hi, I'm dishonest." Like you
They have a
have to
great
get to know
story.
them, right? I
Mm-hmm.
think, when I was launching Silvering, Seth Klarman, the Baupost, was kind enough to give me advice. And one of the things he said really stuck with me, which is integrity. You can't talk about integrity. You have to show integrity. And what integrity
Mm-hmm.
is if you have choice A and choice B, and choice A is better for the client,
Mm-hmm.
but worse for you, and choice B is the opposite. You choose the choice that's better for the client,
Mm-hmm.
even if you don't have to, right? Even if you could have, within the rules of the game, chosen something different, right? That's integrity, because you're kind of living your values. You're sticking to what you
Mm-hmm.
think is the right thing, and you're not just trying to get the maximum for yourself, right? Well, I think it's very hard to like you don't always know people very well, right? And so like I mean, so the question is, to what degree are unknown managers even worth kind of getting
Mm-hmm.
involved with, versus do you need to see them go through periods of time where they had a chance to self deal, they had a chance to do something that would help them at the expense of others. And you have some pretty obvious examples. I mean, when Michael Dell did the take under, my subjective point of view on his company, I was like, how could this be? Founder, big owner, already
Mm-hmm.
a billionaire. Why? Why would you do this? Like the people who stuck with you, like who supported you through your company's underperformance for years, which I
Mm-hmm.
was one small individual. Why would you do this? Yes, it was technically, I guess he was sued and he won. So congratulations to him. He was within the rule of law, but like, is that like what? Like, so how do you know that the person is or isn't going to do that. That kind of
Mm-hmm.
stuff I struggle with because it. If I knew that someone would do stuff like that, I would definitely eliminate that company from consideration.
Mm-hmm.
The challenge is sometimes until that moment comes, you just don't know. You know.
It's a very powerful statement and idea of, I would call it, earning trust. That it's also the investments that we make in businesses, right? And the clients that trust us with their money.
Yeah.
And you could flip it on its head. And I've been in meetings with some managements where the numbers looked great. I did all the work and everything sounded beautiful. And I would walk out very uncomfortable. And I couldn't pinpoint what it is that's not working for me. And it would be, you can call it instinct gut feeling, but I think gut can be a collection of all the experiences you've had so far. And somehow it just rings a bell. And I would walk away from the investment. A few years down the road, there were some accounting issues. The CEO was fired.
Right.
So I couldn't in the moment say why it doesn't work. But maybe I've been in the business long enough to have part of my DNA, this radar that tells me this doesn't make sense. But that helps me on trouble avoidance side, and then rather
I
than.
agree. It's funny, we've reached the same conclusion in different paths. So I'm an MIT guy, I have a computer science and economics degree, so I'm a very logical, linear thinker, right?
Mm-hmm,
And I'm very process oriented, probably partly because of those things. And I used to hate the words gut feel.
mm-hmm.
And now when someone gives me a new idea and it passes some basic financial filters, um, the next thing I do is I listen to a conference call and I actually listen to it.
I do that too.
And
I want to hear their
and
voice.
well, I'm not looking for the voice. I can't even tell you what I'm looking for.
Mm-hmm,
Well, I can tell you one thing I found, and this is could be a bias. I admit that that's possible.
mm-hmm,
I'm looking for someone who is has a proper balance of confidence and humility. So
mm-hmm.
if the management is constantly just bragging and telling how awesome they are, or whatever, because we know, listen, real business is hard. You always have some set of
Of
problems you're trying to
course.
solve and some set of successes and
Mm-hmm,
whatnot. And what I kind of get excited by managers who are very upfront about the problems,
mm-hmm,
even when they don't have to be. And
mm-hmm,
maybe to me, that's a little bit of a show of integrity, kind of
mm-hmm.
on a very small scale. Like, because I think it takes integrity to be like, a little bit less, salesman and kind of more.
Mm-hmm.
Hey, no, listen, guys. There's this area that we're having a bit of trouble with. We're doing X, Y, and Z to be careful. We want to let you know. Like, if you own the business, going back to your idea of business ownership and your influence by Peter Lynch's books, if you own the business and you had a manager, you would want them to tell you that, right? If there
Mm-hmm.
was a set of problems,
Mm-hmm.
and you would also want them to, you would hopefully want to be able to know that they're on top of it, they're handling the problems, but you wouldn't want the problems to be there and some person be like, "Yeah, man, everything is amazing. We're crushing it. Look at us, growth," right? And worse yet, taking actions then to obfuscate the problems and maybe take steps that hurt the business long term to create a short term appearance of being problem free. It compound, right?
Mm-hmm.
So I think part of my heuristics that I'm listening for is a
Mm-hmm.
little bit of humility.
Mm-hmm.
Maybe it's because that's what I like. The kind of people in my personal life, I like kind of quieter. On the one hand versus another hand, people versus no, this is one way. Because right, like the whole cliche of being able to hold two opposite ideas in your head, being a sign of a first rate.
Yes.
And so I think to me that's like the other day I listened to this company a friend of mine suggested I look at,
Mm-hmm.
and the numbers are fine, not great, they're fine. And I just like they felt very investment banksy to me, kind of like.
Uh-huh.
And I was talking to my friend the other day. He's like, "Did you look at them?" I'm like, this is gonna sound very unsatisfying, but I listen to like I just don't like them. I don't know. That could totally be a bias. I get it, but I'm
Mm.
also after 22 years, I'm trusting that cumulative knowledge running around my head, that pattern recognition. Because I used to play chess. Sometimes in chess, you don't know why a move is good, but you just it's the cumulative knowledge. Like the board, this position calls for a certain move, and
Mm-hmm.
so I'm gonna give myself a little bit of a rope at this point in my career and say I'm gonna pass if it doesn't sound exciting.
I'd like to think that we have two minds. The one that's conscious and we can see, and then there's a second
Right.
mind. You can call it subconscious. I think can have many different labels, but it has helped us throughout history. as a species. And I think now we are just living in a much more complex world. The interactions are so layered and nuanced, and the things we talk about, they are so complicated. But at the end of the day, and I had some conversations with some mentors who are all about numbers, and there are moments
Mm.
when they tell me, but Bogumil, how does it feel? And I know they're not joking. They tell me, just ask that question. I ask yourself, how does it feel in some moments? And when they tell me that, I realize I'm not the
Mm.
only one that taps into the emotion. And I'm not that comfortable with it. I'm a lot like you. I'm very rational and logical. I want to see the numbers. And if the numbers make sense, I want to act on it. But then there's a part of me that I'm much more comfortable leaning on these days than I did back in the day when I started off, where I wanted to show you the spreadsheet, where I realized that on a human level, and we're really managing money for people, investing in people, right? Businesses are managed by people.
Mhm.
So numbers are numbers, and accounting standards are better than they've ever been, maybe. But at the end of the day, it's a human to human moment of, do I trust you?
I would add one more thing. I think as an exclusion heuristic,
Mm-hmm.
I'm much more comfortable with gut feel. As an inclusion, I'm much less comfortable with that
Mm-hmm.
because I think, um, you know, I think like my whole idea is to have various criteria, and obviously, like you mentioned earlier in the call, as you lose money in new and interesting ways,
Mm-hmm.
you create more and more the bar rises to prevent bad things like that from happening again. And I think like having heuristic based or gut feel based exclusion
Mm-hmm.
criteria like know you're out is fine. I would be I would personally be not fully comfortable including things just because I think I trust you. Like
No,
I
no.
would say that would be like a checkbox out
Mm-hmm.
of many kind of thing, as opposed to but once you get a strike, like it feels a little I
Mm-hmm.
don't need to I don't need to create a scorecard where you might maybe you get a minus here, but a bunch of pluses, and I just like move on. I don't know. I don't want to figure out if I'm wrong, even if if even if like there's a bunch of type 2 error. Fine, you don't need to own all the winners. Although again,
No.
maybe to your point about the last 20 years, maybe you did. But you just need to make sure you don't have a lot of disasters. I think, especially in a concentrated portfolio.
I like the way you put it. So yes, it's an exclusion tool for me. Like if even if everything sounds good, I would not participate if it doesn't feel right. But then, even if I've done all the work, I want to hear the voice. I mentioned the voice, and that's how I look at it. So these days, you can get transcripts of earnings. I think anybody can look them up online. And back in the day, I would actually call in with a phone to listen to earnings calls as a junior
Mm.
analyst, almost 2 decades ago. And nowadays, I read the transcript, and there are parts of it. And going back to what you mentioned, I want to hear how they said it. And in my mind, it's the under promise, over deliver, or the opposite.
Right.
I just want to hear it how they said it, because when you read the transcript, the same sentence, you can say it in so many different ways, right? And it can have a very different tone. And I just want to hear. And if it's a management I followed for a while, I kind of can hear their voice in my head. I can tell how they would say it, but it's very helpful to me to hear the human behind it. You're
I
telling
mean,
me a
that
story.
Yeah, but the other thing I find that I like about the kind of the gut is like, is this person being real? Meaning,
Mm-hmm.
is this how they would talk to you if they were explaining their results?
Mm-hmm.
Or is this a highly choreographed, scripted, IR department driven kind of thing where obviously most of these are read, right? But
Mm-hmm. Of
which, by the
course.
way, is interesting since most of these
I
are
like the Q&A part.
CEOs sitting in front of a microphone reading some statement, right?
Uh-huh.
That when it's not that,
Mm-hmm.
and when it's maybe someone who has a few talking points and just talking like a normal human would, it
Mm-hmm.
stands out, right? And
Yes.
so, and they find and there's probably a high correlation with founders and other people who, either founders or people who are already very wealthy who've been with the business for a while, because there's this attitude. Maybe I know we're running out of time, so I'll maybe end with a Fidelity story about someone who recently passed away.
Mm-hmm.
So when I was at Fidelity, um, there would be meetings, and all of us would be invited to go to whatever meeting we wanted as long as we were keeping up with our jobs. And I went to a lot of company meetings just as a way of learning.
Mm-hmm.
And one day, the real estate analyst brought in Sam Zell,
Mm-hmm.
and who recently passed away, unfortunately. A great real estate investor, and good, very impactful person in general.
Mm-hmm.
And he, for those of you who've ever met Sam, he's like not the tallest person ever. Or
Mm-hmm.
wasn't the tallest, Actually, he was like pretty short, and
Mm-hmm.
he's like this short guy, stubby beard, sitting on stage. There's about 100 analysts and portfolio managers in the biggest room possible,
Mm-hmm.
and so the analyst starts reading his bio, and this is Sam Zell. He started in the business this and started this company. And Sam stops and is like, "What the f are you doing?" And he literally apologized for the language. But that's how Sam was. Well, I'm just trying to establish your credibility for the portfolio. He's like, I don't need any Fidelity to establish my credibility, right? So when someone, again, maybe that's an extreme, unfiltered, maybe even a crude way of putting it, but I feel like when someone is confident in themselves, or either they built a business or they've
Mm-hmm.
had a meaningful hand in developing the business, they're worth 50, 100, a bill, whatever it is,
Mm-hmm.
they are, some portion of those people are just like, hey man, I'm not going to play your game. No, I'm not going to tell you how the quarter is trending. Nope, I'm not going to try to help you figure out, if the out year estimates are a nickel too low or too high. I'm going to tell
Mm-hmm.
you what I think you would want to know as a long-term investor. And if you don't like that, beat it, right? And I kind of
Mm-hmm.
like that because again, they're selecting.
Mm-hmm.
Where the intention out. They're saying we're gonna do what we think is right. I'm a big owner. I'm gonna try to add value for all the owners. Again, that's a big if. We don't want to get Michael Dell here. Um, no offense to Michael Dell. I'm sure he's a wonderful person, and but the point is they're not playing games, putting on a show. They're just being themselves and saying, if you like it, great. If you don't like it, and that's kind of how I am. Not without the swear words. Like I try to just say what I do and let people opt in and out.
I had William Green on the show, and we talked about authenticity and how people resonate. And you might have the best sales pitch out there, but if you're not real, you use the word real, and I think it's the essence of it. Somehow we pick up on it. We can get fooled
So
into it.
someone told is I read somewhere, I forget, that it's not authenticity that people like, it's
Hmm.
consistency. Their
That's a
point
good
is
one too.
like,
Hmm.
if you sit there naked for a podcast, right? That's
Hmm.
authentic. That's how you are. But people don't want you. At least they don't want me
I see
to
where
be
you're
sitting
going.
there naked, right? They want consistency, right? If you
Uh-huh.
are acting one way here and another way here, another there, that
Hmm.
creates the cognitive dissonance. So it's consistency as a form of authenticity, perhaps.
I like that. I like that. The two have to coexist. And the one point you raised that I really liked was we select stocks, but the stocks are the businesses or the business owners, the companies select us.
Yeah,
And Buffett is very clear about it that he wants just the right shareholders for this particular business. And for a long time before the split, some 20 some years ago, the stock price was so high that for you to invest, for anybody to invest, it was a big commitment. I don't remember what the price was back in the day when they did the split, but there was a certain one of the elements of making it more selective that you made a big commitment to the investment. You're not going to trade. And I think because of his communication and language and everything that he explains, certain people gravitate towards that. And I think it's
right.
it's a beautiful thing that a lot of other companies could lean on as well. Think of what kind of shareholder would you like to have for the business that you're running, and things will start to fall in place. The same way as you and I, professional investors, what kind of clients would gravitate to the story we're trying to tell? That will also help in the everyday activity that we have and the practice. Gary, I could keep you all day, but I have one last question. I like to
Mm-hmm.
ask about success. How do you think about success? What's your definition? Is it a destination, a journey? How do you know you're on the right track?
Yeah, yeah. I think about a lot. I think it goes back to this identity question, right? And I think
Mm-hmm.
one of the keys is to have a multidimensional identity. What
Mm-hmm.
I mean by that is like you you have people who put so much heart and soul into their work, which I think we do. You almost
Mm-hmm.
have to be good, but you forget that I I believe I'm a good investor, but I believe I'm hopefully a good father, a good friend, and a not terrible bonsai practitioner, although I wouldn't call myself good. My point is, if you define success as one accomplishment, I think that's a very narrow definition. It's a very fragile definition.
Mm-hmm.
It's not, resilient to things that are outside of your control, right?
Of course.
And I kind of try to, I ask myself, okay, there's different sectors of my life,
Mm-hmm.
and I try to so I'm Jewish,
Mm-hmm.
and on Yom Kippur, when I fast, I go into nature, and I'm not as into more the organized practice, but I reflect on what can I do better,
Mm-hmm.
where have I come up short against my own goals and bar for myself, which we all do. Well, I don't want to speak for all. I know I come up short.
Mm-hmm.
The mark of greatness is not coming up short. I think you want to keep being honest with yourself and challenge yourself to get up and reach for the bar again, even though you had come up short the prior year, the prior period.
Mm-hmm.
So I have 3 kids. So I think for me, success is doing close to the maximum, because I want to leave myself room for forgiveness for being imperfect in the
Mm-hmm.
different sectors. Hopefully, to be a pretty good husband, pretty good father. And as far as investing, I really want to treat my partners in a way that know validates their trust in me,
Mm-hmm.
and to and which to me means very little, if any, principal agent issues. That's
Mm-hmm.
one of the biggest issues, I think, in the business. And I try to be, if you read my letters, I know you do it. Many people don't read my letters because they're so long. But my point is trying to select for people who appreciate transparency, because you can always
Mm-hmm.
skim, you can always not read, but
Mm-hmm.
there are a few people who really appreciate the transparency of process. And if there's one thing that I've learned, one kind of behavioral mental model that I would leave you and the listeners with, is that kind of like by committing to a process and then explaining how you're sticking or not to it against actual decisions,
Mm-hmm.
it's kind of like Odysseus tying himself to the mast, passing the Siren Island, right? You kind of are preventing or limiting deviation. So I think for me, success in investing would be: did I live up to executing my process,
Mm-hmm.
95% plus, and also treated my partners in a way that, I would say if I were on the other side and our roles were reversed, I'll be happy with. If I do those 2 things, I think I'll be proud of it, regardless of what the end numbers are. But hopefully that those are also means to, over the long term, achieve the right numbers as well.
I like the sound of that. And you touched on so many interesting things, that the self-selecting of your readers or even the podcast listeners. When I write essays, and I got comments to make them even shorter so they are more clickable, shareable. And I thought, they are a certain length. And if somebody commits this much time, I feel like we're closer to being on the same page. And the podcast itself, it could be 15 minutes, but I feel like we couldn't have this conversation in 15 minutes. And I think the audience that self-selects, and I see people listening to the end of sometimes longer episodes, I'm really grateful and touched that they do that. And then they write me an email that they spend this afternoon listening to my conversation with somebody.
Hmm.
It's very touching. I appreciate it. It's a very emotional moment where I feel like somebody spent so much time with the two of us. It's pretty incredible. And the
Yeah.
last thing I wanted to mention, I have an image of my grandma, and I'm thinking I want to treat my client as if it was my grandma, who
Hmm.
is an accountant by trade but doesn't understand investing. And I always feel like, how would I like her to be treated if she was in the hands of an advisor? And there's
Right.
certain things she might not even know she has to ask, and it's for me and my integrity to answer those questions or think of those things. And putting yourself first, I know people say it, but I think people can feel it on some level, that they are treated as if they were the most important for you in this moment, in this pursuit. And I think it's very important in this profession, because I think there's too much selling going on, and too many things and too many commissions to push around and get, and quotas to make. I think a handful of us are actually in a very different pursuit, and I hope that there are people out there listening and appreciating that part. Gary, thank you so much for today. This was wonderful. I really appreciate it. I'm going to include all the links in the notes so people can follow you, learn more about your wonderful writing and about what you do. Thank you so much for
Thank you
today.
so much for having me. Really appreciate it.
Wow, this was great. It flew by.